The difference between a 720 credit score and a 760 credit score on a $400,000 mortgage is somewhere between $40,000 and $60,000 over the life of the loan. That is not a typo. And right now, searches for how to increase your credit score are up 259% over the last 12 months because the average first-time homebuyer in America just hit a record high of 40 years old. The system has never been harder to crack. And the worst part is that most people trying to buy their first home are unknowingly destroying their own credit score in the 6 months before they ever apply for the mortgage. Now, the reason this matters so much today is that the goalpost has moved. 2 years ago, a 740 score was considered excellent. Today, lenders are pricing their best mortgage rates at 760 and above, and the national average FICO score just dropped to 715. We believe most first-time buyers are walking into a lender's office with a score that is materially lower than what they actually need to lock in the best possible rate. There are 5 specific mistakes that almost every first-time buyer makes, and each one is entirely avoidable. Mistake number 1 is applying for any new credit in the 6 months before your mortgage application. Every single hard inquiry on your credit report drops your score between 5 and 10 points and stays visible for 2 full years. Now, lenders do not just see the inquiry, they see what it represents. Multiple recent applications signal financial desperation, which translates directly into a higher risk assessment, which translates directly into a worse interest rate. And the reality is this includes things most people never think about. Store credit cards at checkout, auto financing, buy now, pay later applications. Even a credit limit increase request on a card you already have can trigger a hard pull. The rule is simple. 0 new credit applications for 6 months. Mistake number 2 is closing your old credit cards. Now, this sounds completely backwards, but bear with me. There was a viral story this week of someone whose score collapsed from 859 to 676, a drop of 183 points, after they paid off all their debt and closed their accounts. The mechanism behind this is brutal. Closing a card removes its credit limit from your total available credit, which immediately spikes your utilization ratio. And utilization is 30% of your entire FICO score. On top of that, closing your oldest card eventually drags down your average account age, which is another 15% of your score. If a card has no annual fee, leave it open, use it once a quarter, pay it off. Never close it before your mortgage closes. Mistake number 3 is the 30% utilization trap, and this is the one that costs people the most. Experian explicitly warns that exceeding 30% utilization has pronounced negative effects on your score, but here is what most people miss. 30% is a ceiling, not a target. Look at the data. Borrowers with scores above 760 typically maintain utilization below 10%, with many sitting between 4 and 6%. Now, the secret weapon here is timing. Your credit card issuer reports your balance to the bureaus right after your statement closes, not after you pay your bill. So if your statement closes on the 15th with a $3,000 balance on a $6,000 limit, that 50% utilization gets reported even if you pay it off in full on the 20th. The fix is to pay your card down before the statement closes. This single timing adjustment can drop your reported utilization from 50% to under 5% with 0 change in your actual spending. Mistake number 4 is co-signing or being added as an authorized user on someone else's account. When you co-sign a loan, you are 100% liable for that debt, and a single missed payment by the primary borrower can drop your score by 60 to 110 points. Authorized user accounts are even sneakier because that account's entire history, including utilization and missed payments, appears directly on your report. A LendingTree study of 5,000 near-prime consumers actually found that many authorized users were worse off 3 months later. Pull your credit report from all 3 bureaus and remove yourself from any account you did not personally open. Mistake number 5 is the one almost nobody checks for, and it is the joint accounts you forgot existed. Old credit cards from a previous relationship, a car loan you co-signed for an ex, a joint account from a divorce that was never formally closed. These accounts legally bind you to the other person indefinitely, and their bankruptcy or missed payment can hit your score years later. Now, the action step is straightforward. Go to annualcreditreport.com. It is free, weekly, all 3 bureaus. Pull all 3 reports because they often show different accounts. Dispute any joint account that should have been closed in writing with the bureau directly. Wait 45 days. If nothing changes, escalate to your state attorney general, which has independent enforcement authority that has been notably more active than the federal CFPB in 2026. Avoid these 5 mistakes in the 6 months before you apply, and you put yourself in the top tier of borrowers. the tier that locks in the rate that saves them tens of thousands of dollars over the next 30 years. Most people will scroll past this and learn it the hard way. Thank you for watching.